Ladies and gentlemen, I would not be surprised if most of you know of John Casti and have also read some of his books. I think complexification has actually entered the vocabulary of the complexity community, and that is very much the one of John's books, which was in fact published in '94. John has been with the Santa Fe Institute. He joined them in '92, and he seems to have a sort of dual residence, don't you? Moving between Santa Fe and Vienna. He has been in Vienna with IASA for a considerable time now, because he was in fact one of the first research staff at IASA in Vienna. As you well know, he has focused very much on modeling, and some of his work has, I think, taught all of us quite a great deal of what can be achieved with agent-based modeling and simulation. I first came to know John's work through the work he did with a supermarket. Am I allowed to mention it? You are. Sainsbury? With the Sainsbury supermarket, and that was very interesting, and it takes us back to the importance of the original question, because the original question was, what is the demand for shopping depending on the day Christmas falls on? If it's a Monday, it's a different pattern. If it's a Saturday, it's a totally different pattern. What, however, they found was that that initial question was almost irrelevant. What they did find, and they changed the project altogether, was what difference it made in terms of congestion in the way that the stores themselves were designed. So the original question may be always a starting point, and then when we understand the deeper issues, then we may move all together. And I think that perhaps has gone into a lot of the other work that John has done. So today I'm very pleased to introduce John Casti, and hand it over to you, John. Thank you.
Thanks. Well, as you can see from this title, my talk today is not going to be about supermarkets. In fact, I've spent probably way too many years in the company of natural scientists, physicists, astronomers, mathematicians, computer scientists, and watched with various degrees of disappointment, amusement, and general dissatisfaction the efforts made by people who have training and background in the natural sciences in trying to come to terms with the social and behavioral realm. Okay. And a couple of years ago, I was in contact sporadically with a fellow in America named Bob Prechter. Now, does anybody in this room recognize this name? One, okay. You must be from a business school. Bob Prechter is a almost legendary financial trader and, let's say, thinker, if you like, in the realm of finance. And he and I started talking about some of his ideas about how collective social events of all types and on all time scales actually take place. And I'm not talking about events, grand events necessarily, like the rise and fall of civilizations, but even much more mundane collective social events like trends in fashions, popular culture, elections, the outcomes of elections, going to war, not going to war, and so on. All types of collective social events. And the general thesis that Prechter advocates, and I happen to agree with him, and I started working on this myself, and that's what I want to present to you today. So this is a kind of, it's a work in progress. It's by no means a finished theory, and you'll see why, is that I call it the conventional wisdom, the explanations that you see in the intellectual journals, in the op-ed pages of newspapers, in the media, the explanations for why things happen are always wrong. Not occasionally, or every now and then, or mostly, but always wrong. If the conventional wisdom says A causes B, you can always entertain the alternative flow of causality and say, well, maybe, what would it be like if B caused A? So you have two hypotheses, if you like. A causes B, B causes A. Which one of those hypotheses, when you actually go to the record and actually go and look at the data, is the more consistent of the two with respect to providing a plausible explanation for what direction causality actually flows? Now, I'm going to come to that point in just a minute, but first let me show you a few questions. If I hope that this, oops, there we are. Have a look at these questions. This is a what-if kind of game. Suppose you could predict which incumbent presidents would win or lose the re-election, or the next big thing in fashion, and so on and so forth. Suppose you had a science, a predictive science of social phenomena that you could use to address in some meaningful, useful way these kinds of questions. Now, I'm willing to go out on the limb, it's not much of a risk, to say that if you had such a science, it would be worth a lot. It would be worth a lot to a lot of different people.
But that too is a piece of conventional wisdom.
It is a piece of convention. It's a piece of, it's an assertion. I wouldn't say that it's a conventional wisdom. It's my assertion. And those of you in the room may or may not agree with it. It's an assertion. Okay. I'll come back to the conventional wisdom issue in a moment. Now, I'm not going to promise today to put into your hands a tool that is going to answer these kind of questions. What I am going to put into your hands is a set of ideas that will provide, in my view, call it a probabilistic view, a probabilistic tool for measuring and characterizing trends and changes of trend. See, the biggest problem with prediction in the social realm is that the usual methods basically essentially predict that tomorrow is going to be more or less like today. Just kind of straight line trends. And trends change. And how do they change? That's the question, because the key element in actually answering any of these questions is to try and understand how trends change and when there's going to be a turnaround, if you like, a turnaround. Now, what Bob Prechter had started thinking about is, and he even gave this a name, it's called socioeconomics. And so what I'm going to tell you about is some of those ideas together with some of the development that I and some of my collaborators have made in the direction of a tool that will give you a leg up, if you like, on addressing these kinds of issues. And that tool is based on the fundamental principle that I announced a moment ago, that the conventional wisdom is always wrong. And the conventional wisdom, you have to understand what it is. What do I mean by the conventional wisdom? It has a specific meaning in this instance. It has to do with the direction in which causality moves to explain observed events. Now, my contention is that the explanations of social events, that there's a taken for granted background assumption that virtually all commentators make without question, and that background assumption is just plain wrong. And I'll give you an analogy. Think about the ancient astronomers, Babylonia, Egypt, and so on. They wanted to predict planetary positions, just like certain kinds of astronomers today. And they had a view of the universe, a background reality that went unquestioned for centuries, a background assumption that the Earth was the center of the solar system. And it was unquestioned. But with that assumption, they built a very elaborate structure, cycles and epicycles piled on epicycles and so on, that actually didn't do a bad job of predicting where planets would actually be. But as soon as there was some anomaly that would arise, more epicycles had to be added into the picture, and eventually this system sort of collapsed of its own weight. Until one Copernicus made, let's say, the right underlying assumption. The bold statement, the Earth is not the center of the solar system. The sun is the center of the solar system. And all of a sudden, things got a lot simpler. And all sorts, and then Kepler came along and created, synthesized, if you like, his famous laws of planetary motion based upon lots of empirical observations. Kepler's laws are not a theory, they're a synthesis of lots of data. Now, what I'm going to show you today is more or less for the social realm. It's like what Kepler did. Synthesize from a lot of data, a lot of examples, a couple of fundamental principles that I believe govern all collective social phenomena, from popular culture to the rise and fall of civilizations, and that these principles are based upon a background assumption that's exactly the opposite of what you typically see in the media and elsewhere for explaining social events. The conventional wisdom is an assumption that has been inherited from physics, from the natural sciences. And I'm going to tell you what that assumption is in a moment. But first, since the title of this conference is Business, Complexity, Ethics, and Creativity, Eve Kelly told me that I had to be sure and include these things in some way in this talk. And it's not so easy, to be truthful, but I'm going to give you my best efforts to actually address every one of those words at some point in this talk. But it's the only word I'm not going to address directly is business, because this talk is not about business. It's about the much broader issue of social phenomena, of which business is just, it's one piece. And this is another important factor that distinguishes the worldview from the natural sciences versus the social realm. And I'll tell you this one right now. Typically in the natural sciences, you think about a system, some billiard balls or planets or whatever that are somehow out there, and this is classical physics view, and that there's a big, thick plate glass window that somehow separates you as the investigator or observer from this system out there. In other words, the interaction is essentially zero between you and the so-called the system. That's the way Newton set things up, and it worked pretty good for planets and billiard balls. But even in physics, when you get down to the quantum realm, that picture is pretty dicey. That view, this separation. And by the time you pass into the social and behavioral realm, it vanishes altogether. In the social realm, there's no out there. There is no out there. These systems are all connected to each other. And if you cannot break these connections and pretend, and just chop off a piece and study that piece and imagine that you're making progress toward understanding social phenomena. It just doesn't work that way. It's almost as if you wanted to go to the moon and you went into your backyard and you climbed a tree and you said, well, I'm getting closer to the moon, so I'm making progress. It's an illusory kind of progress because you'll never get there that way because of a fundamental misunderstanding about the nature of the problem itself. So I think that there are a lot of fundamental misunderstandings about the nature of social and behavioral phenomena that have been passed along to us from the natural sciences, and it's time to banish those things from your brain altogether. And the first place to start is with the direction of causation. What causes what? So to pay some at least lip service to business, let me show you an example that does have to do with business. And it's one that I think everybody in this room certainly is at least moderately, if not deeply familiar with. It's the problem of the corporate scandals surrounding the Enron Corporation. Is there anybody here who didn't hear about Enron a couple of years ago? Fine. Well, in that situation with Enron, it basically collapsed overnight. It came onto the radar, if you like, of everybody in, I think it was late 2001, roughly, fall of 2001. And you would see all sorts of statements in the media at that time of the following type. In fact, one of them was even a headline on USA Today. And the headline said something like, Enron collapse spooks investors. And the basic message is the collapse of Enron is going to cause people to be terrified and flee the financial markets, and it's going to be a major disaster. So keep this in mind. The flow of causation is the Enron event causes people to be depressed, and they'll disappear from the financial markets. Okay. That's A causes B. That this action event causes a dramatic change in the social mood. Now, if you believe that, that's the conventional wisdom. And if you don't believe that that was the conventional wisdom, go to the library and look up the newspapers, magazines, financial press, whatever, from that period. Let me show you a picture and then ask you if you still believe that conventional wisdom. This is a picture showing the stock price movement, the Standard & Poor's 500 index, from January of 2000, till about the end of 2002. Now look at this picture. From the absolute peak of the S&P down to fall of 2001, the stock market averages blew off nearly 40% of their value. Nearly 40%. And it just vanished. Okay. Now look at on this picture where the Enron scandal breaks. It breaks after the low in 2001. And look at what happened afterwards. Did the stock market collapse? Did the investors flee the market? Were people massively depressed because of the Enron incident? The markets went up and stayed up for nearly a year afterwards. So if you actually go and look at the data, you come to a different kind of conclusion. You say, well, the Enron event didn't cause people to be depressed. They were depressed already. They were massively depressed before the Enron event ever took place. And so rather than the Enron scandal causing a massive change in social mood, the social mood caused the Enron scandal. Now, how did it cause that scandal? Well, very simply. Enron, back in 1999, its stock price was flying off into the stratosphere. They could go out and borrow money like mad from banks, insurance companies, investors, and whatever, on the basis of this high-flying stock price. And the money came in, and as fast as it came in, the corporate executives siphoned it off to all sorts of different corners of the world. And when the market blew off, all of a sudden, this stock price, it wasn't such good security anymore. And at that point, the accountants, so first of all, the lenders come in, and just like your broker will come in if you make some bad choices and say, I'm sorry, we need a little more liquidity in your account. Can you please give us some money? And the Enron people also faced the same kind of challenge. We need some liquidity here. Your stock price is not good enough for us anymore. And they said, well, we don't have any money. The money's gone. And at that point, the accountants and the lawyers came into the picture, and you have the Enron, so-called Enron scandal. But the point of this example, it's a business example, and corporate ethics at the same time, you might say, is that the conventional analyst says, what impact will corporate revelations have on the stock market? A socioeconomist says just the opposite. What impact will the stock market have on corporate revelations? And it was completely predictable, looking at this picture, that there were going to be some corporate revelations. That was almost, with this picture, a kind of almost a law of nature. What was not predictable is which particular corporation is going to step up and be the one that's on the front page. Well, it happened to be Enron, but in fact, Enron was not the worst. Shortly afterwards, WorldCom entered into the game, and a whole host of other, Tyco, that was another one. There were lots of them. Enron just sort of was, they got priority because they were the first. But there was no way really effectively to predict which company it would be, but certainly statistically, if you like, when you see this picture, you say, somebody is going to be on the front page, and it's not going to be pretty. And it happened to be Enron. Now, this example is an illustration of what I call the central hypothesis of socioeconomics, and here it is encapsulated in 3 boxes. That it starts with what I call herding behavior. Every mammalian brain, down in the deepest part of your brain, in the limbic system, you have a kind of instinct to cluster, herd together, kind of to form mass psychologies, if you like. It's a kind of survival mechanism. And in ways that are still an important research theme that I'm working on myself, we all make, let's say, we have a mood, let's say. optimistic, negative, or whatever. What do you mean by a mood? Well, basically what you mean by a mood is your opinion about the future on all time scales. That's what you mean by a mood. How do you feel about the future? And at any given moment, we all have lots of moods because we say, well, I'm optimistic about tomorrow, I'm pessimistic about next year, I don't know about 5 years from now, and so on. These are all opinions about the future, and so we have moods on different time scales. Those moods get collected together, and this is where complexity science enters the picture. How do these individual moods somehow coalesce, if you like, into a overall social mood, the mood of a population as a whole? Well, nobody really knows exactly how that happens. But I think complexity science can say something relevant about that because it's very analogous to the problem of a contagious disease and the outbreak of an epidemic. You know, every fall you read in the newspaper, well, some new strain of flu is moving around. And some people get this thing, some people don't get it. Some are susceptible to getting it from others, but you have to have some kind of connection or contact with them in one way or another, and so on. And occasionally, if the circumstances all happen to line up just right, an explosion will take place, what you might call a phase transition, and you get an epidemic. And sometimes you don't. Sometimes it just dies out. Well, complexity science should, I think, in fact, I have some friends at the Los Alamos Laboratory who have developed some extremely useful and interesting simulation models of this, the emergence of epidemics, if you like. But unfortunately, their programs are classified because they're doing it for studying biological terrorism. But in fact, in the social realm, the only thing that really differs is that instead of viruses and germs that are being passed around, it's ideas, what Dawkins would call memes. That I'm trying right now to infect your brains with a particular meme, an idea. Some of you are more susceptible than others, and you will catch this disease. And others will be very resistant, and you might even take some kind of mental medicine to make sure that you don't get this disease. But perhaps there will be a phase transition, if you like. Enough of you will get this disease, and you'll infect others, and there'll be an epidemic. Okay? And that's the idea, herding behavior. Now, herding behavior at the individual level then translates into an overall social mood, and which is the way that the social group as a whole views the future on all time scales. And that mood is what is the generator, or call it the engine of history. The social mood is what creates actions and events like the Enron scandal, or women's clothes fashions, or who's going to be the next pop music star, or what's going to be the outcome of the presidential election in the U.S. next year. Okay, those are all actions. So if you want to encapsulate this whole idea in 3 words, the words are thoughts, cause, actions. Now, sometimes when I tell people that, I say, here's the take-home message. Thoughts cause actions. And they look, they're silent, waiting for me to say some more, like I have just expressed some kind of kindergarten tautology to them. And finally they say, well, who would have ever thought otherwise? My answer is, almost everyone thinks otherwise, because That's exactly the kind of the conventional wisdom goes in just the opposite direction, that actions cause moods. Actions cause moods. Now, where does that kind of an idea come from? Well, it comes from physics. And in fact, it comes from the very first law of physics, Newton's first law of motion. Newton's first law of motion says, bodies remain in their state of motion unless acted upon by an outside force. That's Newton's first law of motion. Nothing changes unless an action from the outside impacts upon the system. And that would be actions cause mood. And that's the way it is in physics, at least Newtonian physics. Quantum theorists certainly wouldn't agree with that, but we'll leave that aside. We live in a Newtonian world, not the quantum world, by and large. Now, I know that there are many out here who are thinking, well, yes, moods do cause actions, but then once an action happens, there's some feedback that affects the mood. I ask you to hold your question on that point for a moment because I'm familiar with that kind of argument, and I promise you I will address it. And I don't believe it, number one. And secondly, but more importantly, I'm going to tell you why I don't believe it. Actions don't change moods, but moods certainly generate actions. But let me show you another picture here, just to hammer home the point. Now, actually, before I go on to this picture, I want to say one more thing about this. The key element in this diagram is the idea of a social mood. And you might say, well, this is great. Maybe I even believe this flow of arrows. But how do you measure a social mood? How do I know what the social mood is at any given moment? I mean, do I read what poll takers write in the newspapers or people who give you questionnaires? You know, you're walking through a shopping mall and somebody asks you questions. Is that the way you get a handle on the social mood? Well, my answer, which I inherited from Bob Prechter, and I think it's a good answer. It's not the only answer. There may be many so-called sociometers, but the best one that I know is the Dow Jones Industrial Average. That's the measure of the social mood at any given moment, or the financial markets, let's say, in general. Now, why is this a good measure of social mood? Well, first of all, the financial markets never lie, unlike the kinds of answers people give to questionnaires to people in supermarkets and elsewhere. You mean people say all sorts of outrageous things, or the kinds of answers people give if you ask them, well, suppose you win the national lottery, what are you going to do? Well, they say all sorts of wild stuff. And then you find out, well, what do they really do when they win the national lottery? Well, it hardly has any resemblance to what they imagine that they're going to do. So that's the first point. The financial markets don't lie. Secondly, the financial markets are a perfect reflection of people's view of the future. When you make an investment, you're making a bet on the future, what you think about the future. And you might be a day trader who's making an investment on what I think about the future by the end of today, or what I think about, you might buy a long-term bond and say, this is what I think about the future 10 years from now, or whatever. But every investment is a bet about the future on some time scale. And what do the financial markets do? They gather together everybody's bets and synthesize them all into a single number. It might be the Dow Jones Industrial Average or the S&P 500, but some measure of the financial markets. Now, some people say, well, gee, you know, that's great for maybe, but I'm not a guy like you who calls my broker, you know, 20 times a day and sitting there at my screen watching the markets tick up and down. I'm not involved in the financial markets. So how is my mood reflected in this measure? Well, my answer to that is, you might not think you're involved, but do you have a bank account? If you have a bank account, you're involved. You think that when you put your money in the bank just sort of buries it down in its cellar and it sits there waiting for you to come and take it back? Your bank is recycling that money as fast as it possibly can into all sorts of financial markets all over the world. So do you have a pension plan? Well, then you're involved in the financial markets. You may not be involved directly, but you're involved through your agent, who's essentially you have hired to make decisions for you. So everybody is involved. And finally, the financial markets are really lovely from the standpoint I said earlier that you have bets or views of the future on all time scales, from minutes to days to years to decades. And if I show you a picture of let's just take the Dow Jones Industrial Average. I show you a picture on daily data, and I show you a picture of what it looks like month by month, show you a picture of what it looks like year by year, and I take away the time scale at the bottom, you'll have no idea what the time scale is. All the pictures look the same. They all look the same. They're fractals. They're what are called fractals. They look the same on all time scales. So here you have a measure of how people feel about the future and how they feel about the future on all time scales. And finally, you have these patterns are not random. The financial markets don't move randomly. They have a structure and a pattern to them. And if they didn't, technical traders wouldn't be making nice, comfortable 6 or 7 figure incomes every year buying and selling in the financial markets if there were not patterns and structures. And those patterns and structures can be identified, and they can give you indications about how the social mood is going to change. Not just where it is today, but where it's likely to be tomorrow, next week, next month, next year, next century. So let me show you now this picture that I had up here a moment ago. If it will come on the screen, here it is. Here's political events. Now, from roughly 1920 to 1970. Oh, unfortunately, the graph part disappeared. It's too light. Well, pity. Anyway, the general, let me explain what you would see if you could see it, is that the general trend from, let's say, 1930 till about 1950 is down. I mean, it oscillates, but the general trend is down. And look at the various things that I've marked on these arrows. World War II, German soldiers march in Paris, Holocaust, et cetera, and so forth. Remember, a bear market is one that's moving downward. And that's an indicator of a negative social mood. Depressed, down, negative, and so on. And in those times, lots of nasty things tend to happen. Now here's the second half of this picture. This is, everything's disappeared now, but this is from about 1950 to today. Up there where it says top, that's today, or basically end of 2002. And this was a period after the Second World War. For the last 50 years, basically, we've been in a major bull market. Positive, optimistic, social mood. And look at the kinds of things that happen in these times. Apartheid's repealed, the Berlin Wall collapses, and so on and so forth. Rather nice things tend to happen when people are in a positive, optimistic social mood. And this picture was supposed to show that to you. But take my word for it. That's the way you can see it afterwards if you want. Maybe it's even in the handout. Yeah, it's too faint. I have to redo this slide. But here's the conventional versus the socioeconomist analysis of this. The conventional wisdom says, what impact will political events have on the stock market? Or, equivalently, what impact will political events have on social mood? A socioeconomist will say, what impact does social mood have on political events? So it's, again, the direction of causality is exactly the opposite. All right, now, what else do I have to show? Maybe this one is even worse. Oh, this is really terrible. I'm sorry about this. What I wanted to do was address the issue of creativity. So look at me, don't look at that picture, okay? And I'll tell you what the picture says. You have it in the handout. Okay, and you can actually see it maybe. No, you don't, because I just made it up before this. So I didn't make it up. I created it. Not really. It's okay. I can just the general message is very clear. I said, listen, suppose you want, what kind of measure might you use to characterize creativity, or in this case, say innovation? Well, I wanted to make up a slide that could be.
You continue.
Yeah, go ahead. And so I thought, well, probably something quick and easy that I can get data for real fast is, let me characterize creativity or innovation by just number of patents issued. Okay. Now, we all know that in general, patents are issued to corporations mostly, but they come from research and development done in a corporate realm. There are not very many patents, not very big fraction of them are issued to sort of mad inventors, sort of working alone down in their cellar, but to corporations. And, no change, okay. No, it doesn't matter. The message is that in the 100 years that picture shows, that, and I looked at the patents, and I looked at the financial market averages. Again, Dow Jones averages. And in periods where the social mood was positive and optimistic, where markets were moving upward, patents went right along with them. And when people were in a negative, bearish mood, and the sort of depressed, if you like, and the markets were declining, so did innovation, at least as measured by patents. And then it comes back up again. So again, you have a direct statement you can say that what effect does social mood have on creativity? And the answer is a big effect. Well, maybe this next picture will actually show. Yes. Now comes sort of the summary. And there are about 3 of these. I'm not going to read these things to you. One of the things I hate more than anything else is people who put up overheads and slides and then stand there and read them to you. You can all read better than me. And you can just read them for yourself. I may make 1 or 2 comments on a couple of them. So here's the second one. I've already told you all of these 3 points already, that there's no outside the system. Everything is inside, endogenous. Herding behavior is the starting point for generating the social mood. That's where the individuals come in. But they herd together and create, under appropriate circumstances that nobody really exactly knows, a overall social mood or trend. The wave principle. I told you financial markets are patterned, they have a structure. And the structure that seems to work best is something called Elliott wave patterns. This was something discovered 50 years ago by an accountant named Ralph Elliott, that the wave structures by which the financial markets move, and Elliott even identified the fractal. He didn't call them fractals, but he had 13 different levels of price movement measured from minutes to centuries, or actually in his case decades. Financial markets weren't around that long. Finally, well, not finally, here's the question that I've also tended to address. Why does the conventional wisdom remain so entrenched? And here's the general answer, but I think that it's so entrenched because it's been pounded into our brains for hundreds of years, since the time of Newton, basically, that actions cause changes or moods. And in the social realm, things go in the other direction. Finally, yeah, this is the last one. Well, there was another reason why it remains so entrenched, and that is that because it's a taken-for-granted background assumption that's not even questioned, like the ancient astronomers didn't question the Earth's position in the solar system, the explainers of social events, the so-called pundits, if you like, they never bothered to check the data. You know, why bother going to look at the data? We already know what the situation is. You know, don't confuse me with the facts. Going to actually look at the data, it's not always completely straightforward, I can tell you that. It's, first of all, you have to find the data. Secondly, you have to interpret it. And I want to close this talk. I want to show you another example, one that I think will show up on this screen. Because I actually noticed on the program, if Eva will give me 2 more minutes, there was somebody here who is from Brazil. Okay, both of you. All right, well, you're going to like this example. Because I was in Brazil a couple weeks ago to give a series of lectures at the Brazilian National Computer Center in Petrópolis. And I thought, well, I'm going to show these computer and physics guys something interesting, not just mathematics and physics and whatever, but something really interesting. But then I thought, you know, but I want to tailor an example that's for Brazilians. Because most of the examples that I have, and believe me, I have dozens like the ones that I showed you, but they're sort of Americocentric, if you like. They have to do with American financial markets, American or global social actions. And some people might say, gee, you know, that's great, but, you know, you Americans are a little bit different. I mean, we heard this in the first talk this morning. Americans have their own style, if you like. And maybe all of this doesn't work anywhere else. Maybe it doesn't have any real generality. Maybe it's a peculiarity of an American way of thinking, an American mindset. So, and I thought, well, if this stuff really has the kind of, if it starts down in the limbic system of the mammalian brain, it shouldn't make any difference whether you're an American or a Finn or a Pole or a Brit or a Brazilian. So I got one of my friends to help me, and I said, let's use as the measure of the social mood, not the American stock market. Let's use the Brazilian stock market, the Bovespa index from the stock market in Sao Paulo. And let's focus on social events and actions that are peculiar for Brazilians. Things that happen that you might read about it on page 37 of the newspaper in Britain or America, but it's headline news in Brazil. Okay, so we went and looked up the stock market averages from Sao Paulo for a 10-year period, from January 1993 till the present. And this is a good exercise in being careful with the data, because if you look up this index, it's measured in Brazilian reals. And in that period, there was a time where the index was at like 1 and went to 18,000, in a very short period of time. And in fact, when I first saw this, we thought there must be something wrong with this data. But in fact, there wasn't anything wrong with the data. It was a reflection of massive currency devaluations or inflation and devaluation and so on. So the first thing he had to do was convert this index to adjust it to dollars, a more stable kind of currency. As soon as you do that, then all sorts of interesting things happen. So let me show you this picture. I hope I can show you this picture. Socioeconomics in action. Now this is better. At least now you can see it. Here is the Bovespa index from January 93 to the present. And look at what happens in times of negative social mood. Look at right here. President Kohler kicked out right at the bottom when people were in a down frame of mind. Then, all of a sudden, the finance minister Cardozo receives absolute power, essentially, right at more or less at the top, where he's elected president, up here at the top of that wave. Then there's a major decline all of a sudden, culminated by the biggest bank failure in the history of world banking ever. The Brazilians really, they really know how to do things in style. This bank, and it remains to this day the biggest bank failure in history, Banespa. So the central bank has to come in here and bail them out, and then all of a sudden things shoot off into the stratosphere. The central bank bailout takes place, and then you go up to the top of this chart, July of 1997. That was the high water mark for Brazil. That's when people were at the most optimistic, positive social mood. But it didn't last very long, as you can see. And down comes the stock index to the point where you have the first International Monetary Fund bailout. The Monetary Fund comes in, bails them out. That encourages people temporarily, and just long enough for Mr. Cardozo to get reelected as president. But as soon as he gets reelected, all of a sudden, the whole mood shifts dramatically negative, and you have a massive devaluation of the currency, the real, right down here at the bottom of the social mood. Then things go back up again. Temporary economic recovery, 4% national growth, annual growth. But that doesn't last. And eventually you come down to this point where the IMF has to step in again and bail out the country. And this was just last fall. And in my opinion, any socioeconomist worth his salt looking at this picture, he wouldn't have had any trouble predicting Mr. da Silva's election as president. I mean, a lot of Brazilians seem to be real surprised by this, but it certainly wouldn't surprise any socioeconomist. And I can tell you that as a general phenomena, in times when you have an election and the mood is negative at the time of the election, the incumbent is always kicked out, without exception. So the incumbent in Brazil, I can't even remember who was the president at that time. You probably know. He's already forgotten, but Randy's okay. At the time of the last election, last fall. Cardozo was still the president. Yeah, okay. Well, for sure, I would have certainly, if the London bookmakers were taking bets on who was going to be elected president of Brazil, you probably, a few months earlier, back around this time, you could have gotten some nice odds on da Silva. He was a long shot. But in fact, for sure, Cardozo was going to get kicked out. And who's going to win? Well, the intensity of the negative social mood determines the magnitude of the actions that follow. So if the social mood is really negative, then the person who's going to win is the most extreme candidate. The voters are going to not only kick out the incumbent, but they're going to bring in the most extreme candidate from the other side. And that's exactly what happened. But now, of course, De Silva himself is starting to run in. He has a certain kind of, after the election, a little honeymoon period where people think, well, we got somebody in there who's going to really make some changes and make things happen and so on. Well, yeah, he's making changes all right, but nobody's liking these changes very much. And when I was in Brazil 2 weeks ago, the trend was already down. So, okay, look, the last word here is look at what happened over this 10-year period. Basically, where this market is today and where it was 10 years ago, the social mood, if you like. If you'd gone to sleep for 10 years and woken up, you'd say, well, nothing happened. Nothing happened in Brazil for the last 10 years because your time scale is decades. But if your time scale is months or years, then all sorts of stuff was going on. So time scale matters. And with that, I will close this talk with thanks.